Right, okay, so what I'll hopefully talk on for the next maybe 25 minutes, try and be as quick as I can, is just a little bit of a financial regulatory update and hopefully some sort of key takeaways from that. So what I'll cover is, first of all, just some key themes coming out of the ESFA's assurance outcomes from 22-23. So there's lots of different ways the ESFA get assurance, obviously from the audited accounts regularity. They do their own funding audits, they do FMGS reviews, SRMA reviews, SRMA, SAT return. I'm kind of really just focusing on the outcomes from last year's audited accounts regularity reports, just some of the issues, themes coming out of that. Then talk about key changes with the 22-23 accounts direction for this year end. Obviously, we're doing the audit, preparing the accounts, but there are some key points within there as you're kind of preparing for the year end. A very quick recap, and it will be very quick, on the handbook, Academy Trust handbook that just finished, 31st of August 22. But just in terms of some of the key changes that were in that potentially impact the year end or the year that we'll be auditing. And then obviously coming on to the new handbook that applies from this year and some of the key changes coming out of that. And then a couple of other updates, good to knows, that might be helpful, things on the horizon. Sorry, there's quite a bit of information on some of these slides. Won't go through all of the slides in detail, but you'll get them after, but hopefully just sort of did it to provide the information there. So first thing in terms of the ESFA's assurance outcomes were from last year's audited financial statements. And what we saw there was 99.5% of all trusts had an unqualified audit report. So that's quite good news. You know, most trusts are getting an unqualified audit report. So that means their accounts, as presented, audited, presented true and fair view. Within that, there's kind of a little bit of an interesting trend was, although you may have an unqualified audit report, if there are issues around going concern, auditors will issue what's called an emphasis and matter. So it means the audit report's not qualified, but they're emphasising something, particularly around going concern usually. So within those 99.5%, about 7% of trusts had a material uncertainty disclosure, and that was really relating to going concern. And it was kind of two factors. One was the actual going concern element, so it was kind of raising that actually this trust does have a financial position, financial viability issue. The other was around trusts actually closing, being rebrokered into another school kind of thing. So within that, the actual going concern disclosures across the sector was around about 1.5% of trusts from those audit reports were kind of basically saying, or the auditors were saying, there are going concern, financial viability issues in schools. And that was an increase from the previous year, 1%. So I guess kind of showed that potentially that trend that, as you'll know, it is tougher for schools and some more trusts are facing some of those difficult financial positions and questions. Just in terms of qualified audit reports, you know, there are very few, you know, 0.5%. It's about 8 trusts, I think, something like that. So it's very, very few. And it was all about local government pension scheme valuations and how they treat their land and buildings. We didn't have any qualified audit reports last year, by the way. In terms of regularity, probably the one that's a little more interesting, I suppose, depending on your view. So there, around about 8% of trusts had a modified regularity report. So remembering regularity is all about using funds, essentially using funds for the purposes intended. Reasonably consistent with last year and relatively consistent the last couple of years. The main issues, I've just sort of listed there, I guess the top 4 issues in terms of appropriate internal financial reporting, lack of reporting approval around related parties, and I'll talk about those a little bit more. Alcohol was kind of the interesting one. A lot more incidents of that. Use of purchasing alcohol from public funds, which we know is not allowed under the Academy Trust Handbook. So it seemed to relate to an increased incidence of it as opposed to the value. The values are all still relatively insignificant, so just something to watch. And lack of appropriate procurement tendering policies were kind of the top four, and that was accounting for roughly about kind of 60% of all the regularity issues. Just on the internal financial reporting, I mean, essentially what they were picking up within that issue was things like inadequate management accounts or no management accounts or very minimal simplified management accounts, submitting returns to the DFE, SFA late, inadequate monthly controls, and also absences of CFOs, accounting officers for periods of time. So just sort of encompassing that whole kind of internal financial reporting. And then in terms of related parties, fairly common things I think we've seen for the last couple of years around related parties is related parties not being reported properly to the SFA, not getting pre-approval, no evidence of the cost requirements, and just sort of failing to manage kind of conflicts of interest properly between a trust and related party. Now, with the new Academy Trust Handbook, there's been some changes around a couple of these areas, which are good news. They're not bad news changes. There's some good news changes, some simplifications. So it may well be that those kind of issues disappear. I think from our perspective, and Glenn will touch on this later, but this is probably the area we saw more regularity issues than anywhere really. Was around related parties and similar sorts of themes. It was generally around things like pre-approval, reporting to the SFA. Internal scrutiny also it wasn't in the top four issues, but it was one that seemed to have more regularity modifications, more exceptions coming out last year. The level was relatively low. It was kind of like less than 1% of trusts had a regularity modification around internal scrutiny. But the key issues that the SFA were picking up on was that trusts, they weren't having any internal audit work, internal scrutiny work undertaken at all during the year, which we know you have to. There was no evidence that there was really any risk-based approach to it. It was kind of just a bit of a finger in the air. Well, let's just look at this year. No real reasoning behind why that particular area, and no evidence of how that was being reported back to audit committees or finance committees equivalent. So it was kind of, the work was being done, no real science behind the approach, and then it was kind of being shoved in a desk drawer, and that was the end of it. So those were the key issues they picked up on from the regularity modifications. What the SFA also do, as you know, when you submit the accounts, audit findings report, audit management letter, you also have to submit your internal scrutiny report. So apparently the SFA do review all these internal scrutiny reports, and they've picked up from those reports, scrutinising accounts, that there were a lot of other cases where they believe that actually the internal scrutiny work that's been done, the reporting, wasn't sufficient either. So potentially that sort of level of regularity modification is higher. So I think, I know internal scrutiny is an area I think the SFA is doing some extra work on around maybe some good practice guidance, just expanding the guidance around what they're expecting. So just again, something to make sure that you've got in place with your trusts, for the year that we're auditing, that's finished, but certainly going forward into this year, that you've got an effective option in place. The audit committee are getting involved in setting the scope of that work, and that there's mechanisms in place for how it's all being reported back through to the audit committee or equivalent. So that was just outcomes. Any questions at all on any of that? Okay, the 22-23 accounts direction I've got there the three sort of documents that make up the accounts direction. There's the actual accounts direction, there's a set of model accounts, and then there's a useful for the SFA to provide a guide to us as auditors as to how to do the audit. But it's actually a reasonably useful document, and it's guidance. They're not really telling us how to do the audit. So in terms of the accounts direction, actually for this year end, there weren't really too many changes. It was fairly minimal tinkering, and actually most of the changes were really about clarifying existing requirements just within the accounts, within trustees' report, but also I think really dealing with what they see, or what the SFA call as kind of non-compliance with the accounts direction, and it's really within the trustees' report and governance statement where they're kind of flagging these key issues. So, what were the areas of non-compliance? Well, it's kind of, they provide Coketown model accounts, there's a trustees report in there. They kind of find that, well, a lot of the wording that goes into a trustees report is quite, I use the word boilerplate. They're finding that trusts are just copying what's in Coketown, not really applying it to their trust. So the idea is that, well, your trustees report needs to be about your trust, not about Coketown. It does need editing, it does need reflecting what's going on in your trust, not what's going on in Coketown. And also with that, I think what they've picked up on, and we pick up on this as well when we're reviewing reports, is sometimes the trustees report, governance statement, is not really syncing with what else is going on in the trust, particularly if there are related party issues disclosed in the accounts, but the trustees report says nothing about it. Or actually, the trustees report will talk about what internal scrutiny work's being done, won't really reflect what's actually being done and what's being reported in relation to that. Or there have been SRMA reports that aren't in there, I'm referred to, or FMGS reviews. So within that governance framework, just being able to, if those reports have actually highlighted actually some internal control issues or things like that, but when you read the governance statement, it's basically just saying, well, everything's all okay. It's making sure that from the SFA's perspective, that those reports are really reflecting what's going on in your trust. Other key areas around non-compliance was in the governance statement. Listed a few things there where the ESFA have picked up on. Again, I think coming back to the earlier point about the internal scrutiny, regularity modifications, that's where they've really picked up that, I guess, a lot of narrative disclosures in the governance statement around internal scrutiny, a little weak, a little flaky, often not really giving a lot of information and background. And ideally, what they're looking for is, well, what internal scrutiny option have you chosen? Why have you chosen that particular option? Using another firm, peer review, trustee doing the work. So why have you chosen that option? What's the frequency of work? What's the scope of work? What have they reviewed this year? And what was the outcome of that work? Were there any significant issues? Were there minor issues? It's not having to detail every issue that they've uncovered, but just, I guess, a picture, a snapshot of what was the outcome of that internal scrutiny work. In terms of the accounts, we prepare the accounts for you, for most of you, most of our clients, so they will be compliant with areas, but I know over the years I've had a few interesting discussions around this particular area, which is about trustees' remuneration. So just a reminder that trustees' remuneration has to be disclosed, whether that's a trustee receiving some form of remuneration, not for their services as a trustee, but just if they were on the payroll for a short period of time, or are being paid to undertake a particular project, or the more common issue is staff trustees, so your accounting officer, or if you do have other staff trustees. So just a reminder, that remuneration has to be in the accounts, it has to detail what their remuneration level is in the bandings, what needs to go into that remuneration, and it needs to include pensions. We can't get around that disclosure. I think the other real key change in the accounts direction is around the whole school buildings safety risks and issues, and this is the real, I guess, new element. It's not in the accounts, it's all in kind of trustees report, governance statement, regularity statement. So the accounting officer now within their regularity statement it's not really a change, it was always effectively embodied within the regularity statement, that they now have to specifically state that in signing their regularity statement they have complied with the requirements of good estate safety and management. The other areas are within the trustees report, where you talk about principal risks and uncertainties. You're going to have to expand on principal risks and uncertainties relating to the school estates and that relevant legislation. And also within the value for money statement, which I think is maybe the more difficult area, again is looking at, well, considering sort of value for money achievements, results in relation to the school estate as well. So something within those areas, particularly the first two, that you will have to think about in terms of this year's trustees report governance statement, how we're building in some narrative around those areas. Don't know if anyone's started, probably not, thinking about how they're going to report on those areas. I think with the accounting officer's statement, come on to it later, but I'll address it now. What they've said is that although the accounting officer has to make this additional statement, there's no extra work. We're not having to do any extra work as auditors. We're not auditing the compliance with that. Our regularity audit is all about purely the use of funds for the purposes intended. It's not getting into the proprietary and compliance aspects. So we're not having to specifically, I guess, audit, is that statement correct? Because that could be a never-ending battle, I guess, of trying to do that. So there's not extra work that we have to do, but there's just a couple of questions we're going to ask. You'll probably seen in the regularity questionnaire, accounting officers, we've got a couple of questions around estates safety and management. And also we'll just be asking some questions about, well, what is the accounting officer, I guess, ultimately relying on in signing that statement, but not doing any detailed work. A couple of minor things around accounts. Again, these are issues that we will, areas we'll cover off when we're putting the accounts together, but just clarifying some treatment around loans, particularly things called concessionary loans, which are essentially sale-lease loans, SIF loans that you receive. I mean, generally it's just saying, well, the loans should be on the balance sheet, they should be stated at the value received less repayments due. So no major changes, more kind of clarification. Just a little bit about what income streams they expect to be disclosed in the accounts. And also, I know this is probably the bane of a lot of people's life, is staff number disclosures. So just when you come to that staff number disclosures, that teaching assistants should be within the support staff category, not teaching category. But that's kind of it on the account, so not too much change. The framework for auditors, as I said, it's some guidance. It's actually quite useful guidance, particularly around the regularity engagement that we do. And really the only thing to add in here, which I've really just talked about, is the audit that the SFA aren't expecting us to do any additional work around, in terms of regularity work, around the good estates management compliance with that legislation. As I've said there, we're just asking a few questions, just asking questions, not doing work. The other slight change, well, not change, just emphasis, and it's just sort of useful to know, because this was an area, I sit on one of the ESFA working groups, so I attend the working group that looks at the accounts direction each year. So this was one thing that we specifically wanted changed this year, because last year, and you'll see from the regularity modifications that are presented, things like modifications being raised about management accounts, internal financial reporting is not really a regularity issue. So now, just clarify the guidance so that with the regularity assurance, it should only be a modification if it relates to a financial transaction. So, for a financial transaction, some funding wasn't being used for the purposes intended, or it was a purchase of alcohol, for example, then that relates to a financial transaction. It would be a regularity issue if it was material. If it's not material or it doesn't relate to a financial transaction, then it should just sit in our audit findings report. So that's hopefully, I think, moving forward, we'll start to see less things about internal financial reporting and perhaps even internal scrutiny being detailed in regularity reports, or even more within audit findings reports. Right, Academy Trust Handbook. Just really recapping on a couple of points from last year's handbook, just that are relevant to this year-end sort of audit accounts areas that we could be focusing on, or if they were actually relevant within your trusts. So the first one was around exit payments, so severance payments, redundancy payments, termination payments, for essentially what's called high paid people. So it's where if there was a total exit payment that was £100,000 or more, or if there was an exit payment for a member of staff that was being paid more than £150,000 a year. If any of those payments include a special payment, a special payment is basically a non-contractual one, that whole payment needs pre-approval from the SFA. So hopefully you haven't had any of those scenarios, or will have them going forward, but just to remember, if you do or have and haven't sought that pre-approval, that is going to be something that could be a potential issue. A little bit of clarification about entering into indemnities, and just clarify that it's okay to enter into indemnities as long as it's in the normal course of business. No real definition about what the normal course of business is, but I guess the normal course of business of running an academy trust. So common indemnities we used to see were things like catering contracts, but that is in the normal course of operating an academy, because you are having to provide school meals and things. I think the SFA's expectation and our recommendation as well is just, if you do enter into any, when you're entering into any agreements, any contracts, do review them, see if there are any indemnities in there, and ensure that you just keep a register of those indemnities and are satisfied that this is kind of normal course of business. And then lastly, again, for any of you that are religious designated trusts, I think there's one or two in the room. Just there was, with related party transactions, it's been an issue for a few years, because obviously as religious trusts, the diocese, religious authority will be a related party, so any transactions between the trust and the diocese is a related party transaction, so it gets put all into all the related party reporting and disclosures and red tape. So in last year's handbook, and it's also reflected in the accounts direction, is that if you were a religious trust and you were purchasing any services from the diocese, then they were exempt from the at-cost requirements, provided they were all about protecting the religious character and ethos of the trust. So essentially the sort of per pupil SLAs, that's fine. Still a related party transaction, still has to be reported, still has to be disclosed, but this requirement around it only being able to be provided at cost, it's just deemed to be a cost. You haven't got to go down the route of trying to justify that it's a cost, getting statements of assurance or anything like So a little bit of a carve out. And that was kind of it in last year's handbook that kind of impacts this year end. I wasn't going to go into last year's handbook that much because its history is finished, but those were just sort of the key elements for this year. The biggest changes are this year's handbook. So there were quite a lot of changes this year, but it was all around simplification. A lot smaller, about 16 pages less. The simplifications, yeah, there's quite a few in there. I think the 16 pages less is just less text. It's not 16 pages worth of less requirements. There are a few less musts, but what's really nice this time is within the handbook, on the DFE website, there's a schedule, an Excel schedule of all the musts, and you can actually work through, do your own kind of self-assessment quite easily within that Excel schedule of if you're complying with all of those areas. How am I doing for time? Am I a bit?
What we'll do is after you finish is we'll have a break.
Yeah.
And then we'll go out again.
Okay.
So,
Yeah, okay, it's fine. Detail them there. Main relaxations around management accounts. So now you've still got to continue to provide them to the chair each month, but there's a bit more discretion about how you provide them to other trustees. You haven't got to be every 6 months. You can just, for each board meeting or each finance audit committee, present the most recent management accounts, and those are the ones that the board should consider. It's not having to this process of sending them to everyone every 2 months. And then also this kind of point that they used to have in trustees' report about having to explain how effective financial governance is maintained if you've got less than 6 meetings a year. That's now gone, which is good. Some areas that they just emphasised around financial expertise on the board. This is one, again, it's not mandated, and I know a lot of you do still have sort of staff trustees, but obviously just setting out the ESFA's real preference here is that there are no staff trustees other than the accounting officer.
Question.
Yeah.
Do you need to change your association to change that? As actually states there should be X amount. And I've mentioned that that's consistent that we have staff governance.
Yeah, it's if the way the articles are drafted, stating that the trustees, governors will be made up of X, Y, Z, and then it includes some staff trustees. Yeah, you would potentially have to go through a process of changing your articles, or just not appointing the staff trustee. I mean, it's obviously it's a should, Colin. It's not a must. But I know that a trust where I was a trustee, we had that, and basically we needed to increase our PAN, and what the DFE used us increasing our PAN was a way of saying, well, okay, well, that's fine, we'll approve that, but not until you change your articles to get rid of staff trustees.
We have the same running trust and
Exactly that.
update our articles.
Yeah.
Well, I didn't technically force us, but it was highly recommended.
Yeah.
Clearly, we've updated our articles.
Yeah, they'll use things like that as levers to get you to update your articles.
It's not cheap, though.
No, it's not. An interesting one about electric salary sacrifice schemes for electric vehicles. You don't have to get approval anymore for those, but there is a bit of a catch as long as there's a liability. No liability falls on the trust if an employee doesn't fulfil their obligations. So it's all about obviously putting public funds at risk. Some other areas, I won't go through them, but they've just interestingly provided a bit of information about where they will, circumstances that might lead to a notice to improve, particularly around financial issues or governance issues. So just useful of being aware of those points, and that's likely to lead to difficult conversations from the DFE. Some other areas, obviously just linking in good estates management, it's just obviously that was introduced in the accounts direction, so they're just linked that in from the handbook. Related parties was probably the main thing I just wanted to talk about. This is where there's been some more relaxation. So the threshold for getting pre-approval on related party transactions used to be 20,000. From 1st September, that's now increased to £40,000. And that threshold is on a per sort of agreement basis. So previously there was a requirement if you hit a cumulative threshold of more than £20,000 with a related party during the year, that you then needed to seek pre-approval. That's kind of gone. So the onus now is on, at the time you're entering an agreement or a contract with a related party or renewing one, it's an estimate as well what is going to be the value of that agreement. And if it's a kind of an ad hoc one, it is going to have to be a decent estimate of, well, what do we think over a financial year, academic year, are we going to purchase from that related party? If you think it's going to be anywhere close to 40,000, I would be getting pre-approval for it. There's been some exemptions now out of the pre-approval process. So for sponsors, so if you're a sponsored academy, whether that's from colleges, universities, other academies, now you don't have to get pre-approval for any purchases from your sponsor. The cost requirements are also removed for those transactions, so it just provides a bit more not so much flexibility, it just takes away some admin. This doesn't extend to any trading subsidiaries, so if you were engaging with any trading subsidiaries from your sponsors, that doesn't apply. You would still have to go through pre-approval at cost. Also, again, just extending just building in that exemption for purchases with exemption for pre-approval for purchases from dioceses around religious designation. Again, and I guess the main thing to add is that these changes were principally around the pre-approval process. There's no change to the fact that any related party transaction, whatever the value, still has to be reported to the ESFA. And that's probably the common thing I think they pick up as well, is that sometimes a lot of the reporting is not made until after the event. A couple of really good things to know. There are some changes coming on leases. It's a couple of years away, but it will create some changes around leases and how leases are accounted for. So operating leases will all end up on the balance sheet with a couple of small exemptions. There's an Academy Trust Governance Code that's being developed or has been developed. It's in consultation, so we'll know a little bit more about that in due course. There was a charity governance code, so it kind of really builds off that, but builds in specific DFE related guidance for academies. So it will be a useful tool for academy boards when it does come out and it's released. And just a reminder about good practice guides. Some of these have been updated, and there are a couple in development, which is looking at reserves, more on internal scrutiny, and I think there's an updated one on leasing coming through. Yeah. So just they are useful documents to refer to. And that's me. Sorry for running over a bit. Any questions? Happy to talk to people in the break, or we can pick up in the Q&A at the end.